Hello, and welcome to the Geopolitics Explained podcast. Last week, I set the stage for how debt, inflation, and interest rates interact in the United States. The episode after that, which was Friday's episode, we then focused on inflation and economic indicators. Currently, the economic indicators in the United States aren't indicating that inflation could rise dramatically, but inflation does remain elevated above target. The worry is that fiscal dominance is a political choice, and Trump could make this choice, seeking to lower the debt burden through his pursuit of economic growth and by inflating the debt away at the same time. In today's episode, I'm going to introduce another concept that is important in relation to fiscal dominance, and that is liquidity. Liquidity is how easy something can be converted into cash. In the past, liquidity shortages have forced the Federal Reserve to intervene, often through printing money. Under an environment of fiscal dominance, this could become a recurring theme rather than a response to a crisis. We'll now explore the role that liquidity played in the global financial crisis and in the 2019 Repo crisis. Before diving into the global financial crisis, to introduce liquidity, we need to look at the reserves of depository institutions. This essentially narrows down to reserves held by banks that they keep on hand to meet withdrawal demands or regulatory requirements. In 2008, reserves underwent a dramatic change, and as a result, reserves matter today in the context of fiscal dominance. Before the global financial crisis, banks operated with low reserve balances because they could borrow in short-term funding markets. When the housing bubble burst and mortgage-backed securities collapsed, major financial institutions faced losses that they could not afford. As a result, some institutions failed, such as Bear Stearns and Lehman Brothers, while others required government rescue. This government rescue came in the form of emergency lending and quantitative easing, where the Federal Reserve purchased mortgage-backed securities and treasuries, which injected reserves into the system. This saw the United States switch from a system of scarce or low reserves to a system of ample reserves. To aid this transfer to a system of ample reserves, the Federal Reserve started paying interest on reserves that banks were holding at the Federal Reserve in October of 2008. This incentivized banks to hold large amounts of reserves with the Federal Reserve because they were gaining interest from it. This was initially called interest on excess reserves, but this was replaced in 2019 by interest on reserve balances, also known as IORB. It was these two changes of interest being provided on reserves and quantitative easing that altered bank behaviour and the structure of short-term lending between these institutions. This dramatic change was the origin point that explains everything that has unfolded in the repo markets since 2008. The repo market, which is short for repurchase agreement market, allows one party to sell a security to another with the commitment for the party to repurchase this security at a higher price in the future. Effectively, this is a short-term loan. Banks do this every day in the repo markets to ensure that they have enough cash to operate. The difference between the sale price and the repurchase price is known as the repo rate. Now, we need to flash back to the interest on reserve balances that banks receive if they hold their reserves at the Federal Reserve. If the interest rate on reserve balances is larger than the repo rate, then banks will hold their reserves at the Federal Reserve because they make more interest. This leads to money being pulled out of the repo markets, and the repo rate rises. This happens because there is less cash available in the repo markets for other borrowers. On the flip side, If the interest rate on reserve balances is below the repo rate, then banks will lend into repo because the repo rate yields more than the interest on reserve balances at the Federal Reserve. This contributes to the repo rate falling, and this happens because there is more cash available for other borrowers. For years after 2008, banks were encouraged to collect reserves. This was supported by the Federal Reserve buying assets through quantitative easing. In 2014, the third iteration of QE was stopped. But despite no net injections, banks still had ample reserves from the years prior. Because of this, they didn't need to borrow in the repo market to meet their reserve requirements because they were so liquid. In 2017, the Federal Reserve started selling securities, which is also known as quantitative tightening. They did this by allowing securities to roll off of their balance sheet. This reduced reserves in the banking system, and as a result, banks needed short-term cash more often. By September 2019, these reserves had declined to 1.4 trillion. This led to stress in the repo market due to a cash shortage. September 2019 also coincided with large corporate tax payments, which saw cash drained from reserves and into the Treasury general account. And at the same time, the Treasury also issued new debt, which further increased demand for cash to fund these purchases. As a result of the short-term liquidity shock, the repo rate spiked from 2 to 10% in a few days. This placed the repo rate well above the interest on reserve balances rate at the Federal Reserve. As a result, banks are incentivized to lend in repo markets, and this places further strain on the reserves and on liquidity. In this environment, the banks had more demand for cash than supply that was available in the system. The repo rate is set by supply and demand for cash in the system that is collateralized by US Treasuries. If cash is scarce because reserves are low, the repo rate will rise because borrowers are willing to pay more to secure liquidity from other institutions. This is what happened in 2019. As a result of this liquidity shortage and the lack of cash in the repo system, the Federal Reserve injected cash through the repo markets. It's this dynamic that becomes structural under an environment of fiscal dominance. If a central bank loses independence and the government continues to borrow heavily, banks constantly face pressures on the level of reserves that they hold. This leads to regular cash injections by the Federal Reserve, and this is inflationary. At the same time, the deficit and the debt burden will worsen. In the aftermath of this crisis, changes led to banks being able to access longer-term repos. This wasn't labelled as QE, but it did increase reserves and it did alleviate the cash shortage. The repo rates normalised within a week, but this highlighted that the same risks could happen again in the future. The 2019 repo crisis also led to some longer-term solutions that the Federal Reserve pursued. They started buying Treasury bills outright to permanently add reserves to the banking system. A few months later, we saw a spanner thrown into the works when we saw COVID arrive. It's this that we'll discuss in next episode. Now, to finish this episode, a key aspect of fiscal dominance that we've not discussed this episode is inflation. During the aftermath of the global financial crisis and the 2019 repo crisis, we didn't see inflation rise despite significant QE from the Federal Reserve. However, during the aftermath of COVID, we did see inflation spike. This difference is something that we'll also note in the coming episodes. Today, the US system is structurally dependent on ample reserves to maintain liquidity. If the Federal Reserve pursues QT and pushes reserves too low, it could experience another liquidity crisis, and it could be forced back into QE. This is the cycle through which fiscal dominance could one day emerge. Government borrowing drains reserves. This can then see repo rates spike, and this can form a liquidity crisis. In response to this, the Federal Reserve can inject cash to return to an environment of ample reserves. This could see inflation rise, and this increases the risk of fiscal dominance. Next episode, I'll discuss the years since COVID, and we'll then explore whether the Federal Reserve could experience another liquidity crisis in the future, and if inflation will arise at the same time, creating fiscal dominance pressures. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? I've been Dylan, and I'll talk to you next time.